Welcome to PeezyFX trading. Today I'm gonna go over price action study. So basically what I did was I just scrolled back all the way back and stopped at a random week, okay? And I decided to take this random price action and break it down on the hourly chart so you guys can get a better understanding of what to look for when it comes to the weekly profile and directional bias for the week. So I got a request basically to break down the concepts for people who are brand new to this and who know nothing about it. All right, so that's what I'm going to do today. I have all the annotations hidden right now. It's just a blank chart, and I can take the time-based indicators off as well, and this is what we have. So being intraday traders, like I know most of us are, we hardly have any swing traders in the group. So that being said, you only want to try to trade the weekly profile or the daily bias. And in my opinion, it makes it that much more difficult to try to find a bias without these time-based indicators. This has been a tremendous help for me. And I really want you guys to get used to keeping these on your chart as long as you're on the hour, 15-minute, and 5-minute time frame. Now, when you move on up to the higher time frames, it's irrelevant. You can't see it anywhere. All right, so I want you to take a second and look at what we have here. We have Sunday's price action here. As you can see, we had a down close week, the previous week to what we're going over. We have Sunday's opening price here. What do we have right below this price action? We have this buy side imbalance, sell side inefficiency. Okay. So for those of you who get confused when you hear me say BISI, SIBI, and fair value gap, they're basically all in relation. They're the same thing. Okay. No matter if it's a BISI or a SIBI, they would both be considered a fair value gap. Now, what type of gap is it? What type of fair value gap is it? This would be a SIBI, fair value gap. And this, for example, would be a BISI, buy side imbalance, sell side inefficiency. And this would be a sell side fair value gap, sell side imbalance, buy side inefficiency. So we open up here on Sunday. We immediately trade down to consequent encroachment of the BISI fair value gap. Take this, cut it in half, 50%, nailed it. Also lines up perfectly with this old high. We create a low right at London open and expand higher. What happens right after that? We create a BISI as we expand higher, optimal trade entry, low, high, kill zone, and it expands higher. Now, if you are anticipating a down close week or looking to go short, being that the previous week we had a down close week, 75–80% of the time, we're going to trade up, creating the high of the week on Tuesday during London session. All right, I want you to pay attention to what happens. Now, if you are anticipating a down close week, you should automatically be looking for short-term buys if you want to trade Monday. Okay. As you can see, midnight is here. This is where we trade down into the fair value gap and expand higher. And if you take this high here from the close to the high and extend that out in time, look what happens. Right at New York open, we retrace back into this old high, get an expansion, a small expansion, trade right back down into a bullish order block, 50% of it, nails it, expands higher. Now at this point, we should be anticipating creating the high of the week during London session. Lo and behold, right here at midnight, we trade down, small little fair value gap here, nails consequent encroachment of it, 50%, goes higher, comes back down, last down candle. Right at London open, we create a significant high. Look at the change in the state of delivery, okay? We have this last up close candle and a strong move down, creating a what? Fair value gap, SIBI, sell side imbalance, okay? And this, as soon as this low is taken right here, it's starting to break lower time frame structure. So all during London, we get an expansion lower. We take out this old low and this old low. Now we have broke structure on the higher time frame. 5 o'clock, when you're anticipating the New York open kill zone, anywhere around 5 a.m., you want to anticipate a pullback. Okay, that's exactly what we get here. we start trading up, we take out this old high here, and we cross over into the fair value gap. So there's a small pool of liquidity above this high right here. We take that out, and then we expand lower. We retrace, created a fair value gap right here. There's a small pool of buy-side liquidity above this high. We trade up, taking that out. And another thing is, on maybe the 5-minute or 1-minute time frames, this is going to be a lower time frame breaker. Why? Because we have a low, this candle right here, and then we have a purge of liquidity, taking out these equal highs and this high here. Once we break below, change of state of delivery, taking out this low, price comes back up into it. Take this wick, cut it in half, price trades right up into it at New York Open, 8 a.m. and it expands lower, 86 pips to the downside. When you start to trade up at the beginning of the week, creating a high of the week on Tuesday, the majority of the time, Thursday, between 7 to 11 a.m., London, from New York Open to London close, that will cap off the weekly range pretty much. So if the high of the week forms on Tuesday, then you should anticipate the low of the week to form on Thursday. That's our weekly profile. That's what we have here. On Friday, this is our TGIF setup, signature and price. When you have a down close week, Thursday should give you the low of the week, and Friday should be a retracement. Basically clearing out the liquidity from the down movement throughout the week, clearing out liquidity and rebalancing the imbalances. So at this point, I'm going to put annotations on the chart. Think about what I just said. I called out the breakers. I called out the fair value gaps. Now I'm going to annotate them and highlight them, put the lipstick on. All right, this is what we have. I know it seems like a lot right here, but we're going to go starting off on Sunday. This blue line right here is a daily order block. As you can see, we trade down, we tap it, price hits 1.37300 level and rallies higher. Comes back down into the breaker here and rallies on Friday. Remember what I said about down close weeks, okay? On Fridays, you expect a reversal. Although I said about 70% of the time, Thursday will cap off the weekly range. A lot of the times, we'll create a significant low on Thursday, and Friday, we will take out that low during London, and they will use New York volatility to give you your TGIF setup. So from this low to this high, from here would be your New York open kill zone, optimal trade entry. From this point, we rally up into a London close, 85 pips. But anyway, we have this BISI, buy side fair value gap. So as we open up on Sunday, we trade down into it. Take 50% of that. Consequent encroachment, as you can see, price trades down, taps it beautifully, and then rallies. Comes back down into about 50% of this BISI and taps the high end of the fair value gap. This is the premium level of the fair value gap, and this is the discount level. Like I told you guys before, your fair value gaps are basically smart money concepts version of support and resistance. This is the high of the fair value gap. Once we break it, you want to find support here. Once we trade up and close above this high, this will be your mitigation block here, this old high. Remember what I told you about mitigation? This is what it looks like. As soon as price takes out the old high and closes, you want to get a reaction from that area here to go long. Now, if price were to trade down, taking out liquidity, and then trade up, taking out the old high, this mitigation block would turn into a breaker because we purged liquidity, broke structure, came back down into the old high. So therefore, we did not run any type of liquidity when we traded down. We just have a low, a high, a lower low, took out the old high, came back down into, take this wick right here, cut it in half, and watch what happens, right? Look how the bodies of the candle respect that area right there. Beautiful. Once we trade down into it, we pop out of it, come back down, and react from the high, just like what we did right here. Right? We traded up out of the fair value gap, came back down, found some support at the top end of it. Same thing here. We traded down into it, we closed outside of it, came back down, reacted from the high end of it. Also, you have a bullish order block right here. We expand higher, changing state of delivery. From this point, this is our change in the state of delivery. We took out lower time frame structure, traded down, back up into fair value gap. Barely took out that high, and then traded lower. This last down close candle here, extend that out in time. It's a breaker. What makes it a breaker? We have a high, a low, higher high. Right there. And then we break down. So we have a breaker that also lines up with the fair value gap. That also lines up with mitigation. What would be our mitigation right here? Well, actually, it's another breaker. I'm sorry. Like I said before, this old high has buy side liquidity above it. We take it out there. So therefore, we have a low, a high, which takes out liquidity, and then a break lower. So this candle here, take that wick, cut it in half. That way you can see it better. Take this wick, cut it in half, boom. So you have 3 confirmations right here, basically. 4, New York open, optimal trade entry from the high to the low. Extend that out in time. In between the 62% retracement level and 70.5. Time and price.